Hi there folks, it's James Marley here, co-founder at Livewire Markets. And for all the drama and headlines that have peppered us in 2025, there's one signal that's suggesting a clean bill of health for investors, and that is the bond market. Now, earlier this year, US 10-year Treasury yields hit levels around 4.8%, and alarm bells started ringing. Today, yields are closer to 4.1%, equities have done well, and markets seem to be shrugging off some of the concerns that are bubbling away in the background. Now, my guest today is Charlie Jamieson, the Chief Investment Officer of Jamieson Coupe Bonds. He's an experienced trader, a long-term investor in these deep and liquid markets, and we're going to be tapping his insights to find out what the bond market is telling us today. Charlie, thanks for jumping on the call. Great to catch up as always.
Good to see you, James.
I gave that intro. Bond markets behaving themselves very well at the moment. Give us your expert take on what they're telling us about the state of markets.
Yeah, so we'll probably talk about the US Treasury market as the major bond market of the world. As you rightly pointed out, earlier in the year when Trump was meddling with all these US political institutions, talking about, parachuting his people in onto the Federal Reserve, up to his Liberation Day antics, the markets really didn't know what to make of that and rightfully added a reasonable premium to some of those assets. And as you touted that US 10-year Treasuries got out to 4.8% today and at 4.1%. Treasuries in general this year have all rallied and performed. A lot of what we've read in the media has been very, very negative around the product. There are definitely pathways if Trump engineers these outcomes where that has some credence. I wouldn't deny that. But certainly, it really comes down to why the Federal Reserve might be cutting interest rates and what will the future set out of financing US deficits and debt really look like. And certainly under Treasury Secretary Scott Bessent, in combination with Trump, they've been very vocal about wanting to target all yields in the United States, but particularly longer end yields, which are very heavily predicated to the mortgage market, and they have a very long dated mortgage market. The mortgage market and the housing market is in dire straits in the US right now. And so they really want these rates to come down. And they've done a good job getting 10-year yields down. I think, whilst people have still got inflationary concerns, inflation isn't exactly redlining. It's a little higher than everybody would like, but around 3 in the US and likely to probably come down. US government shutdown, there's slowing macro, slowing labour markets, all of these types of things. But where it really kind of the rubber meets the road for bond market performance is if the Federal Reserve is cutting interest rates because the macro economy is slowing, bond markets will really enjoy that. We've seen the front end will duly follow whatever the Fed does. But in terms of longer dated bonds, they will rally in sympathy with that Federal Reserve operating as it's always experienced the Federal Reserve to operate. If Trump can parachute in a few people and engineer hundreds of basis points of rate cuts for his own political gains, then the long end of the US bond market isn't going to like that at all. Obviously, by cutting cash rates very violently, you're lifting future inflation expectations, but also there's a credit element about what the hell is this? If it's just going to be manipulated at will, but the behest of one individual, I'm not sure I want to support it in the same way. And that's very rational. So for now, I think the markets have come to terms with Trump and the way Trump is behaving. He hasn't been able to get through changing the Federal Reserve as easily as he might have wanted to. There's one governor, Governor Cook, which has had a stay of execution from the Supreme Court, certainly until the next part of next year. But it's our expectation the Fed will keep cutting rates. The US economy ex-CapEx AI, which is a huge, huge component to both the equity rally and expectations for growth, it's actually not going that well. Without all of that, we reckon that GDP is around 0 right now. So, and government shutdown and loss of confidence and still meddling with, US-China tariffs, all of these things certainly aren't, releasing animal spirit. And as we said, the housing market's super clogged up, a lot of depressed housing valuations, very, very low new building permits, all those types of things that we'd see in a more contractionary phase of the economic cycle. And that's certainly where that is at the moment, because who in their right mind would cash in a 3% 30-year mortgage to wantingly move into a 6.5% mortgage? It's financial suicide. So there's just a bunch of stuff that's not trading. But we still expect that as Trump and Bessent re-engineer what they're trying to achieve, then the pressure is certainly to lower interest rates through time. But that's got to be in combination with inflation behaving.
I just want to pick on a word that's been used around markets quite widely this year, and that's the concept of this debasement trade, which is effectively undermining the value of, particularly in the US government debt. I would have expected under that scenario to have seen US government bond yields rise. They've done the complete opposite throughout 2025. What's going on here? What's your take on the debasement theory or trade?
Look, I think the debasement, it's a real concept, and there's no question the US is not as shiny as it was a few years ago. The problem is the next rung down on the ladder is multiple rungs down. Where do you go if it's not the US and the US dollar? You're seeing exactly that same performance in the US dollar, where it's just continuing to gently rise and cleaning out all of these people that have been very vocally underweight and very short. The US still has the highest interest rates in the developed world. If they cut a few times, Australia might actually end up with the highest interest rates in the developed world, which would be an interesting development. But so certainly it's still a beacon of light for capital markets. I think the debasement trade, people moving to crypto, moving to gold, moving to other things, is all very rational to a point, but somewhat speculative, as we've seen, with gold, this exponential kind of rise and then a very violent sell-off. Not in the way that you'd expect it to be negatively correlated around risk markets and the like. What is interesting about the bond market is it is showing those negative correlations again. And certainly, we're talking here today, we just had a huge equity rally, bonds sold off last night. On Friday, when equities were getting clubbed, bonds were screaming higher. And then that reversed into the close on Friday. But I still think that, it's an interesting concept. The debasement is supposed to protect you against unforeseen challenges. As we've seen with crypto and gold recently, that hasn't really been the case. Now, I'm not going to suggest that they're not great asset classes and they've had incredible returns, but predicting their performance through these different types of market environments is still a little bit randomized. It might have something to do with we've had some funding issues in the US. There's a whole bunch of things that have just been gently kind of problematic, but none of which are independently responsible for what's been occurring. But certainly there's been some volatility in repo markets where a lot of leverage participants in the markets are sourcing funding, and that's got to be watched. We've seen episodes like this previously cause deleveraging through markets, and certainly where there is speculation, things like crypto, gold, maybe bonds, maybe equities, can lead to somewhat disorderly unwind. So there's all of these things to consider as we're in somewhat of a data vacuum because of the US government shutdown. But the debasement trade, look, I think to some degree it's very real and very necessary in a way. But at the same time, the next in line is just such a long way down the line that investors are kind of thinking to themselves, well, you know what, I probably want a little less US exposure, but I'm not about to give up on it. And there's the cost to that, as we know, of not being invested has been so high that invariably people have kind of drifted back in after we're being staunchly negative on the US after Liberation Day. And all they've done is got clipped since that moment, really.
As I alluded to in my introduction, we have been peppered with some headlines and reasons for caution. I guess in the face of what's been a stunning equity market rally, bonds have performed well. Most asset classes have done pretty well, but we've had high-profile figures taking aim at private credit. The US government shutdown was a record. Looks like there's a bit of a resolution around that now. Concerns about the sustainability of the size of the US debt pile. How material are these issues when you look at them?
Look, I think they are material. And so, the private credit and the cockroaches comment by Jamie Dimon and the like, there's always credit problems. There's always some fraud in the system. It really depends on what kind of confidence intervals that all lands on. So we've long said that the good thing about private credit is that it doesn't have that systemic acceleration effect like a Lehman or an AIG did in the financial crisis. You can get these individual silos which explode, and names that we've never heard of. First Brands and Tricolor, I think. never even heard of these companies, and the next thing you know, you've lost almost everything. And that will always be its issue. But yeah, look, I think there's no question the credit cycle has been very, very long. It's been one hell of a rally. Its go-forward performance is simply challenged by its starting point from today on. That doesn't mean it needs to be massively problematic, but it can't generate the same kind of yield, or it certainly can't generate the same kind of returns unless corporate credit is going to trade well below that of sovereign debt. And that can occur, of course. I'm not going to say it can't, but the issue there, as we're seeing in the UK right now, the government can just always turn around and tax you more. And so they don't die, as much as we wish governments would die sometimes. They live forever. Credits can die, corporates can die, but whereas these governments, have the ability to keep raging on, rightly or wrongly. So we think that there's a boundary valuation condition in most markets. And in fact, in many markets, you invoke what's called the sovereign ceiling anyway. So many ratings agencies have trouble rating particular corporates higher than the sovereign in many markets. But certainly that spread compression has been incredible. It means that the historical returns in those credit-based funds are just extraordinary. They look awesome. But their go forwards, they're just on a much shorter runway. It's not going to be possible. And there are going to be, more of these issues, hitting the tapes, because we've been at somewhat restrictive interest rates for quite a while now. And so that lag effect and that catch up is just permanently coming. Now, remember, back to the financial crisis, by the time we got to this point, so let's say we're at the end of 2007, the Fed started cutting interest rates very aggressively. And we actually started from the same place, 5.25%. By April 2008, the Fed funds rate had got to 2%, right? Massive rate cutting cycle, absolutely colossal. And then what happened with Lehman and everything else happened 6 months later anyway. So once that credit cycle builds its own negative momentum and becomes its own beast, there really isn't much you can do to stop it. Now, I don't think we've got anything like that this time around, but I think a lot of people take maybe misguided comfort in the fact that we're gently cutting rates and that means credit's going to be awesome forever. I don't believe that at all, but I don't believe it's going to be hugely problematic either. It's just, each investor's got to decide where they want to be allocated. Is that fit for purpose for what I'm looking for? Is it truly defensive, or is it just a low volatility way to get some yield into my portfolio? If the world all of a sudden jackknifes in a different direction, how are those things going to perform? Well, historically, they don't perform that well and they're not liquid. So I think it just comes down to investor preference. Certainly with sovereign bonds, if you pick the right nations, sitting here in Australia, it's the Rolls Royce of bond markets. We're AAA, we're a nice large market. It trades in huge size every day. We don't have fiscal largesse, particularly at the federal level, versus some of these other nations that have got very different fiscal setups. You've got great alternatives. So I think it's a really interesting period coming into 2026. No question that the Trump administration are going to try and accelerate the US economy to get it to the midterms so that the votes come in and they can get another 2 years of majority rule to finish changing the world in whatever vision they have for us all.
Charlie, you've touched on it a little bit earlier, but gold has been a big story this year. It's been one of the standout asset classes. Keen to get your take on the moves in gold, but also if there's been any observations you can make about the correlation between bond markets and gold, given it's viewed as they're both viewed as sort of safe haven assets.
Yeah, I mean, look, obviously gold has been a pretty dormant asset class for the last few decades, and all of a sudden it's absolutely come to life. The problem with it, I guess, is that a wonderful store of wealth historically, but doesn't have any income attached to it. So unless there is that continuous capital reval occurring for you, and there are storage costs, of course, if you own physical gold, there's no question this year's been somewhat of a speculative bubble, starting off from very strong fundamentals where global central banks had been buying a lot of gold, looking to move to hard assets. I think when the Western world just took all of those Russian assets around the outbreak of the Russia-Ukraine war, there's some central banks that thought, actually not sure I want to own US treasuries. They can just kind of take them. So let's get something that we can actually hold on to. And that's where the genesis of a lot of these types of hard asset allocations really started. The problem with gold, of course, unlike crypto, is that you can still go get it out of the ground. I don't have the ability to value it. You should talk to a resources analyst, a mining analyst about that. It's very difficult to value. It has no cash flow. So from a net present value point of view, what is the right price? Is it 4,000, 5,000, 10,000? I see Jamie Dimon, out saying if you go to 5,000, 10,000, ever since that day, it's sold off 10% very violently as markets were wobbling. So not that negatively correlated in that instance. But I think that there is a lot of speculation in some of those assets. And the speculation comes on top of what is a very good fundamental story. So whether those speculators are front running that, hoping to kind of give it to fundamental investor at the end and say, thank you very much. And that, of course, can generate its own momentum. But as we've seen in the last few weeks, I think we hit 4,400 from memory, somewhere around that, and then bang, straight down to below 4,000. The volatilities are still going to be in there, and it's not going to be easy to predict how that will behave under certain market scenarios, particularly if it's full of speculation. So when we talked earlier about, deleveraging, if funding becomes a problem, as it has been, and this is why the Fed have stopped QT, and then they're trying to normalize these funding markets, then if you've got rife speculation in an asset class like that, you could see deleveraging, in the same way that we've seen that at times in the bond market. When you have these huge risk-off events, bonds are very, very negatively correlated, and some thinking COVID or the like, and then all of a sudden, as the margin calls come, people have to sell what's liquid, what they have, what's at a premium, and they sell bonds because that's exactly what they're there for at that time, to say, thank God I've got you. You're trading at a premium. Everything else is deeply discounted. I can sell you because you're still super liquid, and I've got things I need to do with that cash, be that meet margin or go and buy some growth assets that I love, 25, 30% discounted. Thanks you very much. In other asset classes, you just can't do that. And so that's where, this liquidity element that people just don't think about until it becomes sufficient is really important. And I've got no idea what the liquidity of something like gold or crypto would be in those moments. We've seen them gap and really move very violently. If you're okay with the volatility, go for it. I've got no problem with that.
You touched on it a bit earlier about the big impact that the investment in AI is having on the US economy. I know you generally like to stay in your lane, look at fixed income markets, but it's hard to ignore. What's your take on what you're seeing across particularly in US equities and that strength in AI?
Look, everybody knows that the narrowness of the rally. AI capex is either the biggest transformative thing, it probably is, but it's also very crowded as well. Very quickly, everybody loves technology because it's really capital light. You build software or a solution, and then you sell it forever at massive positive cash flow. This is very different. It's starting to get very capital heavy. These data centers, no one really knows their useful life. All of a sudden, we're going to be using debt to finance a lot of this. And I think that's a very different outcome from the bond market's point of view, because I can see how you've got infinite NPV if you control the world and you win the AI race. No problem with that. Your valuation is up, not enormous and unknown, and so therefore exponential. If I'm lending you $1 trillion to build the data centers, I could lose $1 trillion, if it doesn't all work out. And so that's just not going to occur at 6 or 7%, I don't think, easily. You've seen Sam Altman, out asking for government assistance, government backstop to do all of this. In many respects, it is a national security issue, so they may very well get it. But these are extraordinarily large notionals that need to be financed. And so certainly if those technology cash flow free companies all of a sudden use that free cash flow to do this or borrow money, then they become very different in their composition, in my opinion. And so certainly I think that's really interesting to kind of look through. There's lots of cracks with this story in terms of, do we even have the energy to do all this? Is this going to occur? So, but I do think that'll be fascinating to look at, and it's all down the road a little bit. How is this going to get financed? Who's going to stand behind it? How big are these syndicates? Is this the ultimate private credit trade? Where are they going to get? Well, where are they going to get the money? I mean, who's got a lazy trillion to go and do this stuff? So the money's out there, but it also wants, security and collateral on. If you're lending money, it's not on a whim to maybe go and build a new technology that may or may not work, that has a usable life of what? What happens if you upgrade the chips? Is it a real estate play? Is it a technology play? I think there's a lot of unanswered questions, and certainly it's wonderful in the announcement of all of these grand intentions, and the equity market seems to re-rally on every announcement, even though some of it's a bit circular in vendor lending of chips to, to you, who lends the money to that guy, invests in me, and I come back to you. And every time it's announced, there seems to be an uplift, and I get that. But at the end of the day, it needs to be real, it needs to make money, there needs to be a return on all this capital. And the capital sums involved are simply extraordinary. So that may very well occur. That's not my specialty, but I just see that, there's been some concern in markets about the sustainability of, or the delivery of. It comes at a time when, we've already got these kind of issues with funding markets per se in general. We've got the US government shutdown. We think we've got weakening macro, but we haven't had any data for 44 days. So we don't really know, but there's almost no question that when we reopen, the data will be affected by all of that. Certainly, federal workers that haven't been paid for that time, probably not out spending with gay abandon, are they? They're going to be tightening their belts. They're going to have been. A lot of people, and a lot of uncertainty, a lot of things just got shelved and on hold. That should impact the data. It probably helps the Trump administration get rate cuts early next year. So we think the Fed will keep going. But yeah, there's all of that to still monitor into next year. And if that puts pressure on the credit markets and death by association to some degree, if all of this needs to be financed, is there capital for everybody at the same rate? Maybe not. So that's worth thinking through.
Just want to finish up with a quick comment on Australia, where investors have been wishing for and baking in more rate cuts than we seem to have got so far. The most recent inflation data definitely put the skids on. I've read some comments from you being a little more balanced about the outlook, saying we're really only one data drop away from that rate cut being back on the cards. Talk us through your perspectives on the outlook here in Australia.
Yeah, look, I think the surprise to the inflation number was so grand that it's probably, if we have a very weak employment number, that's not going to get the RBA over the line this year. We do think there's a very big change in the methodology of the calculation of inflation as we're moving to a full calculation each month. And that in the way that it's being lifted into the market, it's likely to be slightly disinflationary. Now, a lot of the things that were very evident in the first quarter of the financial year, are unlikely to be easily repeated. So we do see a moderation in that inflation number, but there's no question this is going to mean the RBA are going to go super slow. And as I said, if the Fed go bang, 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 we could have the highest interest rates in the developed world. It looks like the UK are going to start cutting pretty quickly. So they're a little higher than us at the moment, but if they start cutting, the Fed start cutting, and we're sitting on our hands, Australia really has been the caboose in this whole cycle since COVID came along. We were very late to the inflation party, not that it's much of a party. We were very late to come off high inflation readings when everybody else did. And so I do believe that everywhere in the world, we're still broadly in rate cutting mode. We've seen massive rate cutting cycles in Canada and New Zealand, which we believe are very similar to the Australian economy. And those economies are still, pretty down in the doldrums. Their unemployment rates are rising. They're not experiencing accelerated inflation outcomes. They're really stuck, and there's no release of animal spirit to some degree. We just had higher unemployment numbers in New Zealand last week. I just don't think that Australia is going to go completely in the other direction to that global movement. Now, there's no question that we can't move quickly if these inflation volatilities are still around, and there's no question that inflation's too high to be cutting right now. But the RBA, by their own admission, think that the neutral rate is somewhere around 2.75. Currently, we're up in the mid threes. There's still room to come down. As soon as the data allows for them to come down, I think they will. There's nothing they can do to fix housing affordability or any of that. There are so many complex issues involved in that. Monetary policy is only one part of it. But they also, want to deliver a wide outcome for all Australians. Plenty of Australians struggling with the cost of living, and bringing those mortgage costs down will be very well received. It's not going to help people, buy a Sydney waterfront mansion anytime soon. They're already so far out of the reach of most normal people that it's so far beyond what's rational. But, clearly it's an asset in high demand, as all property is in, Australians still live in just a few very dense places. We haven't spread out like the US have, where you've got, large cities all over the country. We're still all congregate together up the East Coast because that's where the majority of the work and growth is in our cities. But we're still seeing, lots of people starting to make that change to, the smaller places, or take that, that rural step. Well, you've done that in your own life in a way. It's a wonderful thing to do to get out there. But I just don't think that monetary policy in and of itself and the rise in property prices is going to slow the RBA down, because they, by their own admission, want to lower rates down towards neutral, as many central banks are essentially looking to do. So it's just a matter of, I don't think the destination has changed. It's just the journey has changed because of the interruption from these higher inflation settings. And I know there's some news articles this morning about the government introducing an electricity subsidy again. Again, this would push the cost of inflation down. One of my favourite sayings, James, is nothing is as permanent as a temporary solution, particularly in politics. And this was a great policy in terms of smoothing out the delivery of inflation. Now, because we got the dip in inflation when the subsidy first came in, what we've really experienced this year is the give back. And so, again, if we go for a smaller subsidy or some type of intervention, then they can smooth this out. And it's very likely that over time, that huge amplitude of these inflation series will moderate out, and then we go back to life as we knew it, or a little bit more normalized in terms of we just don't have rampant volatility in these data points like we've experienced.
Charlie, bond markets, as you say, they're not making the front pages saying, huge returns in bond markets, but it's been a quiet performer in the background this year and probably done a great job for a lot of investors. How are you investing at the moment? Can you just give us a quick snapshot of how you're allocating on behalf of your clients at the moment?
Yeah, certainly in the year we were getting a ton of phone calls, and there was a huge amount of press sensationalism about how dangerous the bond market would be. These 30-year US interest rates could really be quite problematic. All of a sudden, fast forward to, I think I wrote the article last week, long-dated US treasuries are up about 10% year to date, including their carrying capital gain, in excess of the ASX. So heaven forbid, the media maybe didn't get that one entirely right.
That's a headline,
funny old world,
Charlie.
But look, all of the US Treasury complex, most of the Australian complex, all rallying really quite considerably this year. It's doing very well. For our own portfolios, there's still a lot of value in government instruments, in some of the state government instruments. We also invest in things like supranationals, so things like the World Bank, which are guaranteed by multiple nations. And so, yields are very high. The curve is very steep, which is a change to what we've experienced in the post-COVID world. So that also helps the maths of the bond market generate income, which is kind of not that well understood. But certainly, we still like what we call the middle part of the curve, or the belly of the curve. It's very hard to see how we turn around and materially hike interest rates anytime soon, as much as these inflation readings are a little bit too high. If we take out all of the expectation of, you said that, Australians have been expecting these rate cuts. If we don't get them, well, then all of a sudden, the consumption activities and planning of the futures start to change, and naturally, self-adjust in the economy, where the economy slows a little as a result, and then maybe that moderates the inflation. So it is somewhat self-correcting in our opinion. We don't see any material rate hiking cycles. We will get a few rate hikes in Japan, but that's not material. It'll be one or two. Otherwise, broadly, everybody's still cutting at the moment. And it doesn't look like the macro is accelerating in any material way. So getting down to neutral is probably a very rational concept.
Great. Well, Charlie, always good to catch up. It's been a while since we had you on the video. I appreciate you taking the time to talk us through what you're seeing in fixed income markets and across markets more broadly. And always appreciate you taking the time to catch up.
Thanks for having me, James. Take care.